I see we have a lot of people joining. This is exciting. We're going to kick off formally in about a minute. We're going to give a couple more people time to join. Okay, excellent. Hi, everybody. Welcome to Novata's webinar, ESG Regulations in 2024, What U.S. Investors Need to Know. Thank you, everybody, for making time, and I'm sure what is a busy day to join us. My name is Beth Meyer. I'm Novata's Chief Legal Officer. I also have the great pleasure of leading our metrics and regulations team, a band of experts that help our customers and our product build out and understand complex ESG and sustainability regulations and related metrics. Two of those wonderful team members are on the call today, and they are our speakers. Thank you both for joining. Teresa, you and Dr. Caitlin Pentifallo, would you both share a bit of your background?
Great, thank you, Beth. Hi, everyone. My name is Teresa, and I am as part of Beth's amazing metrics and regulations team. I am the ESG metrics and regulations lead. I support Novata private market clients with understanding, complying with, and reporting to complex ESG regulations, as well as staying on top of ESG best practices for data collection. I'm particularly interested in metrics for collecting data on ethical uses of artificial intelligence, diversity demographic data to advance equity, as well as impact evaluation. Previously, I led UC Berkeley's Green Initiative Fund, where I helped formulate and formalize key impact indicators for evaluating the efficacy of sustainability projects. And in another previous life, I also worked with sustainable aviation with the San Francisco International Airport. I will pass it to Caitlin.
Thank you, Teresa.
Thanks, Teresa. Thanks, Beth. I'm Caitlin, and I'm the head of our metrics and regulations team and have the great pleasure and privilege of leading our team at Novata. So we're the team that sources international standards like GRI, IFRS, ISSB, and SASB, and brings those to life on our platform. So we will write and draft those metrics, we'll support that with guidance, and we'll also support that in the form of regulations. So helping to craft those data points, those metrics, those narrative formats, qualitative disclosures that will help pull all of that together and help our private market clients get their frameworks ready for data collection and submission. A little bit about me. I have a PhD in sociology from the University of British Columbia in Vancouver, Canada, where I study the efficacy of indicator-based impact assessments on social and policy outcomes. I've worked at all levels of government, local, nonprofit, federal government, and across a broad range of industry and for-profit and nonprofit partners, and also a credentialed evaluator with the Canadian and American Evaluation Societies. So I love impact evaluation and doing this and applying it at all levels, and most importantly, bringing those impact stories to life through narrative forms of data collection. So really excited today to talk about what is a really hot topic right now, which is regulations across the US.
Wonderful. Thank you so much, Caitlin. Everyone, we're really excited today. We're going to talk a lot about ESG regulations, how they're going to affect US investors, what are the most pertinent regulations you should be mindful of, what it would do with the updated guidance on TCFD and IFRS, how do you figure out compliance across different geographies, all of it. And our biggest hope is that you walk away today with practical tips and understandings that you can immediately apply, and that you feel like you have a grasp on regulations if you don't already. Please ask questions. You can put them in the Q&A. We'll make time at the end to answer them. Before we kick off our Q&A on our end with Teresa and Caitlin, we're going to do a little poll. So please engage. We'd love to hear from you. If you guys could let us know, which regulations are you most concerned about right now? Options are CSRD, SFDR, SB 54VC, Basic Diversity Regulation in California, the California Climate Regulations, or if all those acronyms meant nothing, you can select don't know enough yet to be concerned. Give everybody one more second to respond. All right, we have a slight technical glitch where I can't see the results. So it looks like CSRD is the winner. That's not surprising with 48%. SFDR, I personally voted for CSRD as well. And looks like we have, finally have the results. Next up is the California Climate Regulations. People are worried about the VC diversity regulations, and then an honest 23% are unsure what to be concerned about. That's great. I think all of you are going to find that we touch on each of these regulations today. And if you don't know what to be concerned about yet, in a positive sense, you'll know what to be worried about yet and how to handle that. So without further ado, let's kick this off. And my first question to you is regarding the US regulations themselves. So the ESG regulatory landscape is quickly changing and updating every day. Just yesterday, the SEC adopted their final climate disclosure rule. What would you say is the most pertinent of all the sustainability regulations? What is the most pertinent one for US investors to be mindful of right now?
Why don't I start with this one with something that was top of mind and we were really following for some time. And I always like to say here, especially to the clients that I speak to, is that like, we're gonna worry about this one for you. We're gonna let you know what's gonna be pressing, what's top of mind, and take a lot of that hard part and a lot of that thinking out for you. And I will say, after having watched several hours of the SEC and debate, is that everybody owes us one, because we watched that for about 3 hours in the conference room here yesterday. And I don't know what to say, because it came out, the final rules, far weaker than anticipated, to the disappointment of many on the climate activist side of things. And this is a proposal kicking around since March 2022. And honestly, we had thought until a couple weeks ago, when it started to kind of leak, that we weren't going to hear about it in 2024 in an election year. And it's one that certainly had a lot of opposition to it. This was one of the most commented on pieces of legislation, maybe all time, for the SEC. And I think maybe in the thousands of responses. And I'll just say that in terms of the original proposal, large companies would have been required to disclose not just emissions, scope 1, scope 2 on their own operations, but we're also talking about the entirety of their own value chain. So for anyone that's had the pleasure of working with Mark Fischel here at Novata, that's also talking about scope 3. So encompassing everything from parts, services bought from other suppliers, really encompassing all of that. So as we know, that's a big lift. It takes a lot of work. And so that's a lot going on there. The other surprise is that it's going to take a singular form of materiality, which is in the form of financial materiality, if you do become in scope for this. And so that means that the concept of single financial materiality is that a company of its own accord can decide if this is something that is material to them. So this is, of course, quite different from what we see in Europe. And if you've been around conversations for CSRD and double materiality, where you've got to really take that into account in a really robust way, companies themselves are going to have lots of leeway here to decide if something is or is not going to be material to them. So previously in this March 2022 edition that we have been reading super closely, all publicly traded companies were going to have to report at least scope 1 and 2. We were thinking as of last week, scope 3 was going to kind of come optional. But this has really been significantly watered down. Even in this state, I would say at least 10 states across the country are even going to pursue litigation coming at the Circuit of Appeals, I think the 11th, to kind of stop that in its tracks. Even with what we do have now, I don't see a lot of private companies coming into scope, especially those on the smaller side. Any kind of climate risk disclosures will be phased in over time. We are seeing some degree of attestation, meaning assurance of scope 1 and 2 should you fall into these parameters. However, we're talking potentially, even for large accelerated filers, we're talking 7 years into the future. This is going to be a very generous phase. So when I say it was potentially watered down from what the original reading of this was, that's what we mean. It really was not its original form. And this, not different from what we're seeing everywhere else. The alignment is not dissimilar from language and organization that we're seeing with TCFD. So for those that are familiar with that kind of language, the organization around metrics and targets, governance, board oversight, risk management, very similar language for those that are familiar with that framework. So a lot going on. I don't want to say it's much to do about nothing. There's definitely something there, but it's definitely not what we expected.
Thank you, Caitlin. And one quick thing, if whenever we're going to talk about one of the regulations or the frameworks, if we could break down the acronym, just so that everybody knows.
Yep.
Okay. I just think if people join, they might want to be learning as much as they can. So that's wonderful. Thank you, Caitlin. Teresa, do you have anything you want to share?
Yeah, following Caitlin's wonderful summary of the drama of SEC yesterday, I'd like to talk about pertinent regulations concerning my home state, which is near and dear to me in California. There are three that I want to highlight, and that was on the poll as well. First, I'd like to talk about what's being used as the California Climate Accountability Package, and that is California SB 253 and 261. They are being shared and talked about as a pair, and they are the nation's first requirements in any state for companies to disclose greenhouse gas emissions, both within the company's operations and along the value chain, as well as climate-related risks. So very similar to the proposed SEC climate disclosures, but specifically for California, which absolutely goes one step ahead. And I think that says a lot about California, which historically has led the way in a lot of climate regulation. They require that they made huge way around electric vehicles, et cetera. And so we see this definitely in the ESG space as well. First, around California 253, this is specifically around companies that are with revenues larger than $1 billion. Companies must report their Scope 1 direct emissions, as well as their indirect Scope 2 emissions from the previous fiscal year. This is starting in 2026. I think what is most notable and pertinent for this particular regulation is that assurance, meaning that their results of their carbon accounting must be verified by a third party. That has not been required in the US before, and definitely will be super critical for folks who have never sought assurance before or are new to carbon accounting in general. Closely, the pair California SB 261 has a lower threshold than 253. It is for companies that have revenues of 500 million or more. And both of these are pertinent for companies that do business in California. Although it's a lower threshold, companies for 261 must disclose climate-related financial risks, as well as the measures that they have to reduce and adapt to climate-related risks. Again, as Caitlin mentioned, we clearly see the impact of the TCFD framework. Though it was recently retired, we're very much seeing the spirit of it live on in regulation, as well as in others as well. Lastly, I want to call attention to California SB 54, which has been coined the venture capital diversity regulation. And this applies to venture capital firms that meet certain criteria that are operating in California. And to be covered under this legislation, if you have venture capital investments of at least 50% in your portfolio, then you are required to comply to this regulation. And this would be starting exactly a little less than 1 year from now in 2025, and it is for 2024 investments. I think what is notable about this regulation is that we are speaking about it as if it's just applies to venture capital firms, but looking into the weeds of the regulation, as our team does, we are regulation nerds, the legislation actually broadly defines what a covered entity is. So even though if you are a traditional private equity firm, if you have 50% of your portfolio in venture capital or seed investments, it actually does still apply to you. So I think knowing that now is great, so we can prepare. Just wanted to flag that there might be other traditional private equity firms beyond just venture capital firms that may be subject to compliance here. Those are the three in California that we're definitely paying attention to.
Thank you both. That's so incredibly helpful. I think also really well paired. I think, Caitlin, you're right. SEC was a lot more watered down than any of us expected. But Teresa, like you just said, to underscore that the two regulations coming out of three, arguably, out of California, regarding climate and diversity, these are like a sea change in terms of historical regulations that are being pressed upon VC in general, but also investors. And I think what's really interesting in California has a history of doing this is like they've casted the net quite wide as to who this applies to. So it's definitely something to be mindful of if you have operations in California. If you have any sort of form of office there, this is something you should be really looking into and should be on your radar. Thank you both. Speaking of that, so let's say I don't have to worry about California. I have absolutely no footprint there. I'm a private company. I'm not worried about the SEC's new rule. What implications might European sustainability regulations, which we know are quite broader and deeper, have on US investors, if any? Teresa, do you mind sharing first?
Yeah, I love this question because despite what it feels like, regulations do not work in silos. I think many of the folks on the call or are interested might already be subject to SFDR or have heard about CSRD, et cetera, especially if you are a US company that has operations in the EU, or if you are part of a supply chain of EU-based companies. I think looking more broadly around firms that operate in the EU in particular, there are three big reasons why we should be concerned about regulatory developments in the EU. One is shifting investor expectations. SFDR came into effect a couple years ago with changes this year. But I think especially investors who are primarily based in the EU, knowing that more and more folks will be disclosing ESG risk and opportunities, investors all around may start to demand higher levels of ESG disclosure and information around the performance of their portfolio. This affects US companies that do business already or have a lot of EU-based clients or investors. US companies should be prepared and must be prepared to meet the demands of EU investors or otherwise to maintain both their EU client base as well as additional, like if you want to have an advantage in EU markets. That's my second point. Advantage in EU markets, huge competitive advantage for US-based companies that are hoping to gain traction in the EU market. Complying with SFDR and CSRD demonstrates a high degree of commitment to sustainable practices, and that can only help your firm and company. I think third is to just zoom out a little bit and look at the macro set. Anticipate future regulatory developments is critical. EU regulations like SFDR and CSRD are just part of the larger, broader trend of increased ESG regulation globally. Just last week, Singapore announced that it would require mandatory reporting in 2025. We're seeing this pop up in several regions beyond EU and the US. So no matter the jurisdiction in which you operate, US companies will be better positioned to comply with future regulations if you get started now and take the learnings from SFDR and CSRD, et cetera.
Incredibly helpful, thank you. On the topic of EU sustainability regulations, I think there's two big behemoths. Clearly, they won the vote of the people watching on SFDR and CSRD. Could you share a bit more about those regulations? What do they cover? Maybe break down the acronyms again if people haven't had much experience with them. And when do US investors need to be worried about those two specifically? And if they don't for themselves and their own funds, what about for their portfolio companies?
Yeah, I think I'll start with SFDR, then I'll kick it over to Caitlin for CSRD. So very quickly, overview, SFDR, Sustainable Finance Disclosure Regulation, is an EU regulation that came into effect in 2021 and primarily applies to financial market actors. So not so much the individual company level, but more so if you are an investor, an asset manager. The aim of the regulation is to provide greater transparency around the sustainability information of products, services, so as to drive sustainable investment toward private money towards sustainable investments. So financial market participants must disclose the investment practices at the entity and at the product level. SFDR, I think, is most notable for their principal adverse impact statement. So really honing in on the economic activities and the adverse impacts associated with the company's operations. This differs from the CSRD, the Corporate Sustainability Reporting Directive, which applies more so for larger companies based in the EU. Pass it to Caitlin.
Hey, I'll pick up on everybody's favorite, and it's a really hot topic in this office and in our London office as well. But the CSRD, as Teresa said, the Corporate Sustainability Reporting Directive, it was introduced by the European Commission, and there's a couple other acronyms that go with this that you're also likely to hear that I'll address. And so it was also adopted by the ESRS, which is the European Sustainability Reporting Standards, and those were just adopted in July 2023, and they themselves were drafted by what we call EFRAG, the European Financial Reporting Advisory Group. So between EFRAG and ESRS, that's when we really get into kind of the nitty-gritty and the metrics of how all these documents kind of come together and work together. When we zoom out, though, more broadly, CSRD really enforces the idea that both private and public European companies, but not just European companies, also non-EU companies, those with subsidiaries or parents with subsidiary companies in the EU, those with a substantial presence, need to report on sustainability related impacts, risks, and opportunities. Another acronym that you're going to see across all these documents is IROs. And in terms of why that's important, it's truly the first of its kind. I would say this is one of the biggest pieces of sustainability related legislation, perhaps in the last 25 years. And it's truly at the heart of it, asking companies to better understand the impact that they're having on the environment. And it's doing this across not just the environment, but also in terms of business practice, in terms of governance, and then across communities and the impact that they're having on societies across the value chain, and across a number of other different areas across E, S, and G. It's not just a standalone document. When we think about the European Green Deal, we're also talking about SFDR, the Sustainable Finance Disclosure Regulation, and also the EU taxonomy. So none of these, as Teresa earlier said, are really existing in a silo, but they're really meant to operate and kind of interlink with each other, and kind of come together in that way. I think when people hear, oh, it's EFRAG, so that's EU, oh, it's European Sustainability Reporting Standards, that's EU, there's all these phases, there's what I can omit, there's things being phased in, there's a lot going on over there. Does it really matter to me, a US-based investor? And to that, I would say you really kind of got to dig into what's being called out and when. And to this, there are different kind of criteria that we can really, spend the rest of our time talking through, but just to kind of give an idea. When we talk about large undertakings, this is one of the groups that will come into play here. These are subsidiaries. They could be subsidiaries of US parent companies that are going to meet 2 out of 3 criteria in 2 consecutive financial years. So it might seem like a logic puzzle, but we're talking about different balance sheet totals. We're talking about net turnover and then levels of employees. So the bar isn't actually all that high if you are a US-based company that would be based in the EU. So you've really got to think about these different kind of phases that are coming into play. And so we talk about them in terms of they're going to be reporting on 2025 data in 2026. They're going to be reporting on 2027 data in 2028. And so there's all these years, and it's not just these next 4 years, it's going to be going on kind of into the future, and really looking at how that comes into play in the longer term. In terms of kind of quick facts to think about, well, what do I want a US investor to take away when I'm talking about CSRD? It would be that it could impact you as a US investor just as much as anybody else. You really need to start working with your portfolio companies to find a good provider. And if you are one of those large undertakings, you're probably doing that now. You've really got to start that process quite early, and acknowledge that each portco on its own has got to go through its double materiality process at its own timing, with its own pacing, and individually. You can't kind of do that as a collective. It's certainly not that kind of one size fits all. And each company's got to go through that, even if they are in the same sector or geography. It really is quite an individual portfolio company on a company by company basis that they have to go through. So I don't say all this to scare anybody or think it's got to be going on, but I think preparedness is really key. Starting early is really key, and getting to know and understand what data is being asked and when is really kind of critical to preparation with regulation of this size and type.
Thank you, Caitlin. I want to say CSRD is possibly one of the most complex climate-related, sustainability generally related regulations out there. And Caitlin just did a really great job of breaking down the highlights of what people should be concerned about. And I agree. I think looking at it and saying I'm safe, I'm not based in the EU is not the approach. This is something that's manageable and doable, but not something to get caught surprised by. Leading into more EU focus, but also on a global scale across different jurisdictions, there's been increased guidance from the International Financial Reporting Standards, IFRS, and changes with respect to regulations that are tied to TCFD, the Task Force on Climate-Related Financial Disclosures. What do these updates mean for firms and companies that report against those standards? And what specifically should U.S. investors be thinking about given these recent changes?
Great question. I think when we are speaking about ESG more generally, there's always a term of, there's the alphabet soup of ESG regulation. I think interoperability is top of mind for anybody, I think, that's working in the space and in the industry. Great news is that we're seeing a lot of interoperability already. If I really want to emphasize the point that it feels really crowded, but it really isn't. I think a great example of this is the mirroring and marriage of IFRS as well with the EU Commission. So in 2023, the European Commission, EFRAG, the European Financial Reporting Advisory Group, which is the group that's tasked with drafting the technical standards that will be used to report to CSRD, along with ISSB, who runs IFRS, as well as the SASB disclosures, released a joint statement where they confirmed a high degree of alignment of their respective climate disclosures. I think that should give everybody a sense of solace. I think there's a high overlap, and they released a statement to confirm that. I think the degree of overlap can be, and what's required in reporting, you can see that in areas and themes and topics around social but more specifically around carbon and climate risk. Carbon and climate risk is really the foundation of ESG regulation across several jurisdictions, and even within carbon and climate risk, they all heavily pull from or directly reference to, for example, GHG protocol or the UN Paris agreement. I think we should take comfort in knowing that many of these regulatory and standard setting bodies talk to each other. They are aware of the difficulties and challenges that the space presents. They're heavily involved in each other's comment and proposed draft letters. I know because I read a lot of them. And I wanted to call out and highlight that there are a lot of resources out there. I think another great example of interoperability is CSRD's concept of double materiality. It really builds off of and follows the heels of GRI's impact materiality concept. It's not quite the same, but they're elements, and they're definitely inspired by. I think that GRI and ESRS and ISSB, they constantly release so many resources, whether that's data mappings or reconciliation tables, or sometimes even one-to-one comparisons. There are resources out there, and I really want to emphasize that. And it's not scary. Everybody knows that it's difficult, but look for the overlap. Feel confident in where you are reporting, and being prepared to report is, I think, a good thing to note.
Thank you, Teresa. Caitlin, do you want to share on this?
Yeah, I mean, I am passionate about the metrics. There is no one more passionate on the subject of interoperability than Teresa. And Teresa has all of these resources where they have matched them one by one, and I love it because it is so helpful when we are putting together all of these materials, because we're obviously asked these questions all the time of how am I going to build this framework when I'm seeing this one next to this one, and how do I choose what to add? And it's so helpful that obviously we have this expertise in-house, but it matters in terms of what you're doing, what your goals are, and what standards you're going to apply, and how this is all going to come together in terms of kind of the world out there of what's going on. On the one hand, I think the pessimist could say, it's too much going on out there, I don't know what to choose. Why can't y'all just pick one and throw your hands up and say that? And to that, I would say, I look at all these standards, even though there are quite similar things that are out there, as different shades. They're different shades of maturity, of progress, of industry specificity, all of which are going towards the same goal. I think there are places where we do see kind of things coalescing. As Teresa mentioned, I do think we see that around GHG. I think we see that around GHG protocol. What I'm doing, though, when I'm talking to our clients about how to best prepare, what do I need to have in here, I'm going towards an objective like getting my portcos to get their heads around something as big as CSRD. And that's to look for really the highest common denominator. And what I mean by that is that there are some standards that will get you all of the way. And there are some standards that, so for example, if you were to report on all of ISSB S2, you would have coverage for everything that included the former TCFD. If you were to just follow what was in TCFD, you would not necessarily have covered everything in ISSB S2. So if you were a Singaporean company, for example, I wouldn't advise you to simply follow the former TCFD framework. I would think about what your goals and objectives are as it related to those standards, to that regulation, what it was you were trying to do, and what your goals are, whether it was geographically, regulatory, whatever it might be, industry specific. And so I think in terms of where these standards are going, this is another thing I could talk about for several hours, but when we think about, where GRI came from, GRI was a direct response to the Exxon Valdez oil spill and crisis. GRI has been around since 1997. I think it's easy to say that's the oldest standard. What's going on with that one? We've got all these new and fancy ones. GRI is actually near and dear to me and Teresa's hearts. Yes, we play favorites. No, we don't play favorites. We love all the standards, but it's critical in terms of this really foundational piece that does drive a lot of the other work that other standards have done. And so we really see complexity coming in here when we talk about things like SBTI, which is Science-Based Target Initiative, when we see 1.5 for coming in for Paris Agreement, when we see climate scenario analysis coming in. One of the things that did remain in the SEC piece that came through was that if you are, say, a waterfront hotel property, you have to talk about that climate related risk. You have to talk about what impact the climate might have on your business. And so that's the one thing they got to stick, that very real and present danger that the climate does pose on that way of business. And so for me, I find that really fascinating. So I don't see it as the splintering of standards. I don't see it as, oh, here's one more thing. We all know that ISSB is only 2 years old. I see it as shades going towards the same goal. And really, I do see it as signs that we're working together and truly getting better at it because it is becoming more complex.
That's amazing. Also, you two are very clearly experts. I think this can, the interoperability is amazing. It does give opportunities for people to kill many birds with one stone, although that's not the most sustainable, friendly proverb. I would say a lot of this can feel overwhelming. So if someone is new to ESG, if a firm has not previously fallen in scope or haven't had to consider it, maybe their LPs aren't demanding it. What do you think is going to be the biggest challenge for complying with these regulations or aligning with these reporting standards for US investors?
If you want me to go first, I would say getting started, buy-in. It's hard and it's something that doesn't happen overnight. For those that are getting acclimated to those more regulatory pieces of data collection, there is a lot to do. And so I wouldn't recommend, just sitting down and being like, okay, I'm ready to do it. Let me just sit down and, log in. You're talking about collecting data across departments, across potentially your value chain. We're talking about getting information through all kinds of places, whether it's your HR systems, your financial systems, your business travel. There's all kinds of places that you need to collect this information, and it shouldn't just be this kind of one person running around and kind of like doing all this stuff. It really has to be this like fulsome experience that a company has to fully be bought into. It can't be this one person anymore that maybe even, 3 to 5 years ago, we were seeing this one person like doing this job and like doing their best. The winds of regulation like are here. It is this new era that we're in and that we're a part of. I think it's for the best. I don't think that we need to think about regulation as this kind of punitive era that we're meant to be, punished by. Not breaking the law is not the point. The point is to better enable businesses to see the impact that their business activities are having on society, on the environment, on the communities in which they live and operate. And to that, I would say compliance is in many ways a byproduct. So yes, we would love for you not to break the law, not to incur fines, but we would also love to operate more sustainably within and across these communities. So the more that you can get started early, the more that you can encourage that buy-in and you can get that mental shift going, I think the better. Yeah, and I'll stop there. I know Teresa probably has things to chime in on this one.
Yeah, I think another biggest challenge, I think, would be Costs, especially if you've never conducted a materiality assessment. More especially, I think opportunity costs sometimes too. Like I've done it this way, or I've done maybe an impact assessment, but not quite the double materiality that CSRD requires. I think Caitlin mentioned having, starting now, getting that mindset shift, super critical, especially if you do not readily have ESG expertise available.
Wonderful. Thank you both. And I think Caitlin, really great point about, this is not compliance as a byproduct. I think one key thing to observe is transparency is driving nearly all these regulations. It's saying transparency for you, find out what's actually happening, what are the impacts on your business, climate related risks, but also what are the impact your business is having on the world and the people around you. That's not supposed to be a harmful thing. It's supposed to help you run your business better and manage your risks. It also is better for the economy, for everyone to know what exactly are they participating in and investing in. I know we have several more questions we want to get to, but we're running close on time, and I want to make sure we answer the questions that people audience. I'm going to do just one last one, which is if everyone listening today could walk away with one thing to help them, or just one thing you wish that they would take as their big summary from today's webinar, what would that be? Caitlin, how about you start us out? Teresa.
Ooh. Teresa wants to tell them.
Love key takeaways. I'll start, Caitlin, and then I'll hand it off to you. I would love everyone on this call to feel a little more confident in their reporting capabilities. I think you're more often than not more prepared than you think. You're attending this webinar. You should pat yourselves on the back, truly. I think taking the opportunity to also lean on peers, be confident, lean on peers, lean on resources. That's what I would say.
I would say don't panic, but get started.
I'm actually going to answer this one too. I did mention in the intro, prior to joining Novata, I was Associate General Counsel and Head of ESG of Techstars, a global venture fund and accelerator. So I keenly know how overwhelming this can feel. And where do you start? Caitlin, you're right. You say start, but like where? Teresa's right. You started by attending this webinar if you haven't started already. But I would say my key takeaway here is like get help and admit where you might not know and might need to get more support. So, if listening today was really helpful, that's fantastic. Like feel free to follow up with us. We have some time for question and answers. Ask your questions. Don't be shy. Don't assume you should know things you don't already know. I think it can feel very overwhelming when there's a bajillion acronyms shared, or people are talking about things around carbon accounting that you're just not familiar with. This is still novel. These regulations are very novel. These are things that it's okay to say, I don't know, and to get help. So I think my biggest takeaway is like, raise your hand. There's a lot of groups that want to help people on this. There's a lot of other people that are trying to navigate it that you can join. And we're also here to help you. So with that, we're going to turn to Q&A. Some wonderful brave souls have already put some questions in. We'll go to those first. And if you have anything else, please put them in. We have a couple more minutes and we want to make sure everybody gets their questions answered. So first one is, lots of info coming in. Can you repeat or clarify if a PE firm has companies in its portfolio company that operate outside of California, but have contracts with large public companies that operate in California? Would they fall under SB 253 or 261? And what are the compliance implications of those portfolio companies? Teresa, do you want to take this one?
Yeah, happy to take this one. So great question that really gets into the nuance of how the regulations are showing up for practically on a ground level for companies. I think if you yourself is not the entity that's being spelled out in SB 254 and 261, it sounds like in this question they are potentially like a supplier of a large company that does operate in California, in which case you would be considered in the downstream for that company. And so if they are subject, then you may be required to share more information around your practices. And that is specifically for scope 3. Good thing around the California climate accountability regulation is there are phase-in timelines. So scope 3 will not be required to comply for folks until 2027. So yes, but you have time to prepare.
Wonderful, thank you. Next one, how can a fund of fund private equity firm lacking direct access to companies it invests in through PE firms it supports effectively manage ESG exposure and tracking given its handoff model? Considering the firm's role is primarily as limited partners rather than general partners actively operating these companies, what strategies can be implemented to ensure robust ESG practices and accountability across the investment portfolio? If either of you want this one, I'm more than happy to take it. I'll take it.
Let's see Beth do this one, then I'm going to chime in.
I think a fund to fund has actually a tremendous amount of power in this. Actually, I would argue the LPs have the most. Like you're where everyone is turning to try and get an infusion of capital, and what you say matters. I think a lot of the growth in ESG outside of regulations has actually been because of LP pressure. So in that, I'd say the strategies can be in your diligence. It can be things that you can add it into your term sheets. It can be in part of a stock purchase agreement. It can be part of your limited partner agreement. You can say these are mandates that we require. We require annual reporting on these ESG standards. I will say the DDQs, the diligence requests that LPs run on GPs, can often be a tremendous forcing mechanism for them to advance their own ESG practices and what they're reporting to. I also think just also offering education of saying this is important to us and this is something that we want to put you in touch with. In terms of accountability, shameless plug, I think Novata is an incredible way to say we have LPs on our platform to say, we're going to have you reporting to us here. And these are the metrics that we're going to be asking you for. And this is the way that we're going to hold you accountable because we have great insight and clarity into what you actually are doing. Caitlin, back me up if you think there's anything.
Yeah. No, I love that. And there are some great examples out there of ways that industry leaders and industry groups have helped LPs with this exact thing. So I think two of our favorites are the ILPA organization. So that stands for Institutional Limited Partner Association. And they've got great templates out there under their responsible investing and stewardship section. So these cover DEI, it covers ESG. And then they've got one that does cover kind of industry stewardship most broadly. And they've got DDQs that will be industry or sector specific, and then just kind of a general one. And they're kind of all along the very same veins that Beth is talking about. They'll walk you through like a DDQ process, and they can be like quite in depth or like quite kind of quick going through that process. And those are ones that we see as quite popular. And then I would think the second one is PRI, Principles for Responsible Investing. And we see a lot of uptake for those too. So I would say, even though we see tons of GP activity within our networks, it's certainly becoming more and more common, I would say, for LPs to exercise that muscle and get that information coming in either through a diligence, through deal sourcing, and to make that happen in the platform. There are others that other firms will also use in that LP seat, but I would say those two are the most prominent, that being ILPA and PRI. And those are things we could connect you with too.
Thank you, Caitlin. All right, last question. We are seeing our portfolio companies subject to requirements from larger organizations we sell through, mainly large retailers like Target and Walmart, to comply and report to them, even though we don't meet the legislation threshold. Will you be providing reporting templates within the platform to help us report and comply?
Ooh, the value chain. I actually find that it's Walmart actually has one of my favorite public facing sustainability reports. So it's super well documented. It's really well articulated. And one of my favorite things, it's really well supported by evidence. So for every single GRI metric that they will put on their website, it's going to link out to sources, to data, to documentation. And so likely coming from this question, the information that you provide is going to surface there, which I just wanted to say is very cool. And I love that it's coming from that transparency perspective. So what I would imagine is that that larger company, like the Target or the Walmart of the world, is probably using some form of software that's going and reaching out to each piece of their value chain. So value chain is a European term that encompasses both upstream and downstream value. So not just where distribution is going, but also where ingredients, where any kind of resources coming into the product are going to. And I think anyone using a software like that is going to be doing some form of supply chain survey. And so in most cases, they would provide that template to say, this is what we're looking for from you, in a way that's going to match the data collection that's coming back in. So that's something that we're always kind of brainstorming on, because everyone wants that to kind of match in the way that it's going to aggregate and feed into that. Because as you can imagine, Target and Walmart probably have, I can't even imagine what those supply chains would look like, but logistically a massive task. So there probably should be, because they aren't standardized, something quite specific coming from Target and Walmart that I would imagine is going to come through on their side. I do not believe that you know, we're seeing clients like that on our platform, but it doesn't mean that we wouldn't. But that would be a supply chain quite specific survey related to those companies. I'm just saying they're not companies of ours because they are quite public, quite large companies. But Beth, any other ideas for that one? Or
No, I think
Teresa?
that's really helpful. And you're right, we're private market oriented, but I do think if you want to use the data that you've put into the Novata platform, you're already a user and you want to pull that off and use the analytics or the metrics you've answered there. And that's an easier way to respond to that. Absolutely. We have the ability to input custom metrics for our customers. So if you take the questions they're asking you and create that as a template, that's something we can absolutely support.
Yeah.
I know we're a minute over time and I'm sure we're losing people, but if anyone is still on that has a question, we're happy to stay a little over. All right, we got another person. How can I encourage members of a larger PE firm to prioritize ESG factors, especially given our investments in industrial sectors where there's a prevailing focus on returns over tracking these new ESG objectives? I love that question. I think getting internal buy-in is critical and it's hard. I think there is an inaccurate view that ESG is like superfluous and it's not going to have returns. I think especially if it's in industrial sectors, climate risk is huge and something that needs to be either mitigated or preempted if that's even possible. And you're never going to be able to do that if you're not already having practices and processes around ESG. So I would say I'd encourage them in a non-forceful manner for education, offer training. Maybe it's like a lunch and learn to the rest of your team. And make sure it's not, you know, hey, I'm preaching the value of ESG. This is where it could be a genuine value add to us, either having a better grasp over our returns, having a better grasp over the risk of our portfolio based on these investments. And also these are the regulations that we might be subject to in the future. And so rather than being caught off guard and not being prepared, let's start now. I think it can feel like an uphill battle. I've done that myself. But it's something that it just makes sense. It is something. We're living in a world where I don't know what sector wouldn't be touched by environmental and social risks and governance specifically. So taking the time to educate everybody, and that's also something you can get help with. We're happy to help you with that. Can go a really long way.
I'd love to add something. I'd love to add something to that, Beth. Great response. I think this is something we hear a lot from, especially from folks who work in primarily industrial or emission heavy industries. I think I love the term ESG, but sometimes this separation of it feels almost wrong in practice because of course there's plenty of overlap. And I think we shouldn't think about risks as ESG risk and other risks, like they really are the same risks. And I think we are not new to the risk that climate risk will pose on a lot of portfolios. I think that's also something to hammer down. I'm really excited to be in this space because we're only going to hear more and more, we're only going to get more and more results, more and more evidence around how prioritizing ESG factors will play out for portfolios. I think also I had one more, it's around, I lost it. One thing. We talk about risk a lot in ESG, but I would really emphasize the opportunity part, risk and opportunity piece. Like, I think we're scared of risk. We operate out of fear. Let's try not to do that. Let's see the opportunity in the ESG factors and things. I would emphasize that as well.
Great point. And you're not going to do great with like industrial climate tech if you haven't already people on board with ESG. That's a great point. It's a huge opportunity. Thank you, everybody. Okay, someone said we have no more time. Okay, thank you, Caitlin. Thank you, Teresa. This is incredible. Thank you, every single person that joined. Please stay tuned. Go to novata.com. We have more webinars coming up that will do a deeper dive on the regulations we talked today and also how to comply with them. So please stay in touch. Please reach out if we can help you. And thank you, everyone.